You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, good to be with you.
Mr. OPEC decided, I'm going to keep pumping as much oil as I can into the world market. What has that done to the other kinds of markets?
Well, I'll tell you, it's part of a long decline in commodities that's been going on since the first part of 2011. There was quite a robust rally there, and we have a trick pony that comes in every once in a while, and we call it the momentum peak forecaster. And it sort of has to do with credit spreads and things, and it came in indicating that surge of speculation, I think it mainly blew out around April or May that year, and the speculation was in base metals and precious metals, and lesser so in crude oil. But anyways, it came in, and our advice was that the last signal we got in that was 1 in 80, and then back in the early 70s, and it was suggesting that it would be a cyclical bull market peak for most commodities. So they've come down. And base metals and the grains and various others. And we want to step back one more notch for crude oil. When 2008, before the crash, the crude oil prices went wild. It was the peak oil story was really being touted. Everybody was going to run out, and you had the Middle East problems, and went up to $147. And I remember that in May or June it was, we were getting readings on the upside exhaustion model, and we had a weekly, and wrote that, this would be late June, that that would indicate a cyclical bear market for crude, and that if the monthly upside exhaustion came in on that thing, which we had to wait till the end of the month, came in, that would likely indicate a secular bear market. So that was just straight on technicals, and indeed we've had a cyclical bull market, and I think this next decline would turn it into a secular bull market, a bear market. And the interesting thing is that in '08, at that peak, all I was looking at was the nonsense of peak oil, and knowing that markets eventually prevail and sort things out. And then it turns out that it was the ability to drill sideways and the ability to get fracking on tight geology for gas, natural gas and crude oil. So then what you've had then in natural gas, you had, which is used to be just basically a North American market, and it soared up. Your previous highs were in the order of $12, $13, and lows might have been about $5. But here you had this one with the excess supply, crude all the way down in the panic, or gas came all the way down to, let's say $2, and now we're trading around $4. So earlier in the year, we started talking about that somewhere all of this increased supply due to fracking of oil is going to break the market. And but you just follow the trades. For example, last year we had the rotation model from December, where there'd be a rally. They bottomed out till spring, and crude rallied out to $1.07. I think we had $1.05 as a target, and then it became overbought. So this going into this fall, we were looking for seasonal weakness into December. We were looking for, at some point, let's call it the price adjustment, the new paradigm, such that crude oil takes a big hit. You can't say it's going to fall the equivalent from, say, $13 to $2, but it's going to fall down to quite a low. So then you had the other one, where back in 1985, the tin cartel was quite ambitious, and they ramped the price of tin up so sharply that big traders were offside. When it collapsed, it put some pain into the London Metal Exchange, and the Bank of England was quite displeased because it had to bail things out. But the main thing is that the tin cartel had squeezed the shorts, so there was sure bids on the way down. But the main thing is then it was an official, semi-official, quasi-government cartel. They call it a tin council. So when it failed, then you could shift your view over to the producers cartel, oil, IPC, and they oil producers, OPEC. Then they, at least I remember watching it, thinking, hey, these guys are soon going to be seen not to have any power. So crude oil drifted down, and then it was, I think the high for that year was around 35, and then it drifted down, and then I think at the end of the year it was around 30, and then by March of 86, it was down to $10. Now, also at that time, we did not know that Reagan had worked out a side deal with Saudi that should the price of crude go down, that the Saudis would not attempt to support it or deny the decline, because Reagan's objective was to take out the communists, the Soviet Union, and they needed hard money, and they were getting the money from export of petroleum products, and that was a great contributor to the collapse. So then, since the summer, on our pages, we've been noting that it would be a very good thing to deny money to Putin, which we've called a neo-Soviet. He wants to rebuild the old nastiness of the Soviet Empire, and he needs hard money to do it. And then also the crazies in the Middle East, of which there's never a shortage, they need money too to prosecute terror. So it would be a very good thing politically if crude oil were to come down, and sure enough. But the interesting thing was that this week, when the U.S. market was closed, there was an OPEC meeting, and somehow the decision was that they weren't going to do anything to support prices, and it was they talked about maintaining, market penetration and things like that. But let's just look at it as in the terms of financial history. In post-bubble contractions, commodities come down, and we have that. Then unique with crude oil, you had this nonsense about peak oil. That's out of the question, and you have new supplies and new innovations coming on. And you have a seasonal decline, and you have a change in paradigm where there's so much supply coming on, so it's shifting. So the story's looking good. We're going to go to much lower oil prices. Now, because this week's plunge I remember looking at it, writing yesterday, a 70 level, writing away about crude, and look, the 69 level, and then finally it was down to 68. And then came the news about OPEC. So what you have is a news item. So maybe it's a little oversold in that, but I see it going through at less than 68 here now. So it's wonderful stuff. I like it. So this then is going to affect other commodities. The sector that we have liked for a number of months was the grains. Agricultural prices, the symbol is GKX. It was really beat up and come down a long ways from 2011. And it was so beat up that it looked like it was starting to do a saucer bottom, which it did, and then actually recovered and put on a nice rally. And now I think it's technically gone about as far as it's going to go. And, of course, it's now vulnerable to this dramatic drop in energy prices. Base metals, but they really didn't crash recently. And they were neither oversold nor overbought. We've been using one trick on that is that copper can have a low, say, in November, maybe into December on seasonal. But then you now have the crash in crude oil going on, and this lowers the costs of mining. It all relates to energy. Sure, you may have a dam to generate, but if you're doing a lot of blasting, those are hydrocarbons, and they're all tied to petroleum. So the base metals look like they've had a crack here today. I think they're going to head south a little more, and haven't had a chance to look at some of the others like lumber or cotton by that. But declining crude oil prices are part of a long decline in commodities that started from a very excessive overbought in 2008 for crude and 2011 for most of the other commodities. And it can continued down. Now, here's where the inflation bugs have a problem, is that they look at the Fed as an evil instrument. So do I. And they consider that the Fed has the ability to depreciate the dollar to zero. I don't think so, because the Fed needs speculators in order to get its portion of credit out the window. And those speculators haven't been in hard items lately, not in gold, not in silver, not in base metals, but the speculators that are allowing the Fed to be easy have been in lower grade bonds, and the stock market. So what you have now, and this is the stealth item in the stock and bond market equation, is when the spreads start to widen, and that's the difference between high grade bonds and low grade bonds, and that reversed in June on our model, and spreads have been generally widening since, but nothing too dramatic. It's been quiet, but they widened. They're back to widening here now. And also the other one we look at is spreads between triple B and treasuries, and that has been on a relentless widening. So the credit markets here we've got to talk about the yield curve, which is the difference between, say, the treasury curve between long dated and short dated. And it's been flattening for a year now. And we have found that on previous business expansions that the boom, and the boom is in stocks and low-grade bonds, and definitely not quite a booming economy, although people are buying lots of cars. But at any rate, the curve can flatten or even head inverted on such a boom, and the boom can run 12 to 18 months against an inverted curve. We're now at 12 months. So somewhere the next month or so, this curve can reverse to steepening, and that has been the signal of another wave of deflation. So, and it's also worth pointing out, Jim, that the Fed was established in 1913 to prevent setbacks in the financial market, because setbacks in the financial markets were followed by recessions. There's been 19 boom and recession cycles since, so it ain't working. And here we have another one. It doesn't work because the Fed may be able to push short rates down. It can't influence what the market does in the form of the curve or in the case of spreads. And we've got widening spreads, and that was the signal in 2007. It was a signal for us in 2000 and any number of bear markets through the past. So it's all very precarious now.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Bob Hoye, Chief Investment Strategist for Institutional Advisors. Taking a look at the stock market charts, mostly in the U.S., things are going up in the Dow Jones Transportation, their utilities. The S&P down slightly. Their stock exchange is not reacting as much to the lower price for oil as the Canadian and Mexican markets, where, things are down quite a bit.
Oh, yeah. And a Toronto stock index, it's got the energies and it's got gold in it. So it's a bit strange index. But the S&P has been on a run here, a fabulous run since the middle of October, when a correction was accomplished. And also on our technical work, it gave one of these springboard buys. And we get one of those, you're not sure how long it can remain positive. Last year, it gave a springboard buy in October, and we were looking for the markets to recover through to February at least. And on this one, who knows? It's highly. You've gone back to very bullish sentiment, and technically you've had a really terrific run here without correction since the middle of October, and then now you've got this huge deflation on commodity side. It's not healthy at all, and you have also, like, we do charts sometime that are interesting. For earlier in the year, we noticed that butter, of all things, was going straight up. Applied the technical research to it and said, hey, this is a top. And then yesterday we noticed the same in feeder cattle. The cattle have been, beef prices to the moon. And, well, it's done some technical things, and it looks like a top. But we put these in, one, to show that technical analysis works, and the other to show that it works really well when the particular product is not manipulated, such as the stock market. And because, you got the official bid in there when anything goes wrong, and then you got the central bankers talking about buying bonds. The Fed has quit buying bonds, and Europe just talks about buying bonds. So that's a very precarious market. The decline in gasoline has been proportionate to the decline in crude oil, and the orthodox thinking is, oh, great, now people have more money in their pocket because they're not paying out so much for gasoline. But no, that crude oil and gasoline prices are coming down is indicating that the global economy is coming down or slowing, or whatever you want to call it. So I'd look to the decline in energy prices is indicating a slowing economy globally, and it is not a refresher for folks to go out and buy more cars.
Well, of course, people talk about the car loan bubble. You take out an 8-year car loan. By the time you hit about year 6 or 7, the loan is worth more than your car. So why not just walk away from your car?
That's what happened, because also financial guys have been bundling up those car loans to essentially bankrupt people, bundling them into securities, and the institutions have been buying them up. It's like they were doing that with the housing things, the subprime mortgage bonds back in 2007. So anyways, what we want to look now, what's this doing to gold? Well, of course, gold itself and silver have been coming down with this. It's understandable because the U.S. dollar has been steady to slightly firmer. And the equation of hating the Fed, knowing it's going to be hopeless policy, and buying gold just doesn't work anymore. We emphasize you want to look at it as an investor, and you want to look to see what is going to increase the profitability of gold mining, and that will be the gold bullion price rising relative to the costs of mining this stuff. And again, I mentioned energy costs for the base metals, and it's the same thing for precious metals. So those energy costs are coming down, and the real price of gold, as we measure it by our gold divided by commodity index, it had a low in June, which we now take as a cyclical low, so we're now on a cyclical bull market for the real price, and at some point that'll hook up for the stocks. But at the moment you got financial pressures, and you've got the street looking at the dollar price of gold, and it's down, so same with the gold stocks. So now we did a major gold study a few weeks ago pointing out what has worked for us in determining gold's direction, and that is to do the technical analysis and to keep track of the credit markets. So going back to September, we thought that there could be a good buying opportunity for the gold shares towards late October. In the middle of October, we said, no, not yet, let's just hold off. Then last week, the last few weeks, we've been saying that in order to get the turn in the gold sector, you'd want to have the gold stocks rising relative to the price of gold. It came down with all the nastiness for the last few years, and it's had a low. It became very oversold, and the ratio between, say, the Hoye and gold got down to as bad as it did in 2008. And also is oversold too. So it's had a bounce, and it's down test, and then it's had a down tick. So one would like to see this Hoye divided by gold ratio stabilize for quite a few weeks before one wants to really enter into buying some gold stocks. Now, our edition of a week ago, last week's, we mentioned that one could buy the next dip. And so now we're getting the next dip, and yesterday's advice, well, don't rush into it, because this crude market and commodities may be soggy. Remember that we've got typically a December low for crude oil, and we are not even into December yet. So it's on the gold sector, it's time for research. Pick your stocks and wait until we get a more confident signal on the sector.
Bob, thanks a lot for doing all that number crunching for us.
Always good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Questions and comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.